Great to have you back, Pete. You were very well received.
Great to be
Um,
here.
yeah, on your first visit with us, and I know you do a lot of short-term stuff.
Of course. Of
Um,
course.
you're a little bit too close to your camera, is what my producer is saying. There you go. Back up a little bit. So, what do you see? What do you see happening in these markets, Pete? We have the ECB tomorrow. Since you and I talked, we had the at least the risk of China turning into something systemic. The Fed continues to cancel any type of lift off on rate. Where's your head at in this market environment, and what are you focused on for the days ahead?
Yeah, of course. So I think I'm going to touch up a lot on what we talked about last time, but I believe last time we talked more about the psychology of the trader as opposed to the psychology of how I transact in the markets. And one of the best decisions I made as a trader is to understand that a market is 80% range bound. We already know this as traders and individuals. So I feel that a lot of people try to establish trend trading systems. A lot
Yeah.
of individuals try to analyze fundamentals, and I'm not going to necessarily say that I ignore those, but in my daily trading, my goal is to be a transactor, and we talked about this in the past, and today I'm going to share quite a bit of how I go about this. So what we
You know,
know,
that's an interesting point, Pete, because I've been told by, guys that I respect their work, that all the action in FX is corrective. And this guy's an E-waiver. So you
it's
would think he'd be talking about impulsive, that there are trends, but because of the battle going on between central banks, most FX action is corrective of
Well,
some degree.
it's a fact that the market is efficient, and just doing back studies, and we're going to take a look at this in some of my examples, is that the way that a order comes into the market is what creates the spikes out of consolidation that, as average retail traders, the general public is trying to chase. So what we have to understand is the amount of volume that comes into a market, and that became very apparent to me when I started looking at institutional feeds. And from a retail side, you can't see it because you can get liquidity at any time in a retail position if you're trading up to $5 per position. But when you try getting on the institutional level during hours where there is not liquidity because books aren't open, you're going to see 20 pip spreads across pairs that you would normally see on a retail fee that's a 2 pip spread, let's say. So this really got my mind thinking because I felt that from a retail platform we were being we were missing the bigger picture of liquidity, and liquidity is what creates movements. Now, price's function is to search for liquidity. Price is only trying to fill the orders that are coming into the market, and these aren't market orders that are coming in from the guy trading one standard lots. We're talking about 300 million lot positions coming in and so on. So that's where I feel people need to understand that it is more important on a daily basis to transact in the market at a highly efficient level. Just as price is highly efficient, so can you be as a trader. So what I mean by that is, a lot of people consider spikes to be fake outs and deal runs, which they could be, but when you look at the anatomy of the price, you're going to find out exactly what is happening, because essentially, if we're in a consolidation period and we see a large movement out of it, there is some type of order coming into that. Now, if that's a 100 million block order coming in from an institution and there's only 1 to 5 liquidity coming into the market's going to jump out of that consolidation, run until it finds offers to fill that bid. Once that bid is complete, there's not going to be many price chasing mechanisms there to chase the price to fulfill the bid. So you're going to see what is pretty much a parabolic move, and that's what you see me talking about all the time, is parabolic moves back into efficiency. And essentially what you can do is you could trade it both ways. You can trade the reversal of a parabolic spike knowing that it's going to come back into the range, it's going to come back into the volume base of the market. And from there, then if you have time of day, if you have sentiment in the market, because remember, the market is not always in sentiment. It is in sentiment probably 10% of the time, if even. And from there on, you can get a continuation trade off of the base. So I feel that every single retail trader I talk to, 90% of the time, they will enter a trade, and within 1 to 2 minutes, they're 15 pips, 20 pips behind their entry. And that is because they're chasing price. Well, if you understand how the mechanisms of order delivery work into the market, you will never chase price again. You will always look for pullbacks to the volume base where price came out of, because that is where interest can be filled.
Okay, so would a good example be, Pete, the NFP number was surprisingly negative at the last report, and Euro spiked, I don't know, 100 pips or so within a millisecond.
And then
within a period of time, we did get a reversion back to the mean.
Of course, and by the end of the day, we got back into that. And, that brings up a great point, Bill, because fundamentals I handle totally different. The spikes that occur out of fundamentals, from my research and from my understanding, and that's the number one thing that I would like for people to get out of this, so to say, interview, is that you have to take it upon yourself to create an understanding that you believe in. And that belief can't come from me or you or anybody. It has to come from research, and it has to come from repetition of watching things occur. So when I see fundamentals occur, what I believe is happening is that you have a core base of liquidity, you have a consolidation channel, and then 1 minute, 2 minutes before that NFP or whatever significant release it's going to be, standing liquidity is moving away from the market because they're smart and they don't want to get whipsawed, entered into a movement. So at that point that NFP comes out, it only takes a small order, because there's no standing orders around the price to create a spike. And again, it goes back to the core of what I said initially, is that price's only job, let's put it, is to find and fill the orders that are currently in the market. So if pre-NFP, if there's nobody with a sizable position within 50 to 100 pips up or down of the current market price, if that number comes out good, and there's one institution that says, you know what, and we all know that there are institutions that take a lot more risk than they're supposed to. We read about this all the time, rogue trading and whatnot. And they will say, hey, instead of sitting on my feet, the number came out, I'm going to take a position on this. And that's what creates the spike. But just because spikes are coming into the market doesn't mean that that institution is going to be able to have the liquidity to exit that position for the profit that you're seeing. And that is where the market is then correcting itself. And those are the self-correcting mechanisms of the Forex market that are coming in from the banks that are creating this market.
So, Pete, how do you monitor this? How did you know there were no bids, no offers by institutions pre-NFP, that it was a market with no liquidity going into a number like that? Do you have a platform that you can see these things on?
Nobody does. Nobody, not even the biggest institutions in the world do. It comes from an understanding of psychology of what I used to do as a retail trader. What I used to do, let's say 5 years ago, is I would see that pre-news we're going to have a spike. So people would trap the market, right? But you would want to trap the market, let's say 20 pips on either side, so that if you get in, your order is not going to come out. But then we would see the whipsaw coming in. So over time, through research and through just kind of seeing the bigger picture, just thinking about what is happening.
All right, so you can't learn experience. You have to live through that to get it.
That's it. That's 100%. 100%. And that's where you have to, that's where I could sit here and show you everything I know, but that doesn't mean that you're going to understand it, because the only way you can understand something is if you create an internal understanding of what you are trying to accomplish. So I would like to, if I could, just show some examples here of exactly what I'm talking about.
Okay, so the screen here is in the upper left-hand corner. It's a green box with an arrow.
Gotcha. All right. So let's
and then it'll show the different screens, and you select what you want to show.
All right. So let's just might as well, since we're in here, just take a look at.
Okay, got you.
Let's just take a look at what I was talking about yesterday. Is the sound okay? Can you still hear me good?
Yeah, everything's good.
Perfect, perfect. So this is one great example right here on the Audi USD, and it's not a pair that I talk a lot about, um, but it's a pair that I honestly love because it has smaller, precise movements in terms of, let's take a look here, what happened on Monday. So obviously we come in here Sunday, and just taking a look here, what creates this spike, you know? And this is all in the Asian session, so it doesn't even matter. And I don't start getting interested until the 3 o'clock hour. So we can see right here, this is where my mouse is right now. This is about 3 a.m. London Open, right? So from the psychology of a trader, what I can see here is that a spike occurs, right? And then after the spike occurs, what I can see is that I have a volume base here, and I believe that if I were to poll the audience live here, what we would see is that individuals are going to look for an opportunity to go long on this pair because psychology has people afraid that they're going to miss that ride to the moon. And this is where we've talked about in the past that there's no elevator that goes up to the clouds. Every elevator stops at some point. So what goes up must come down. And that's why I say that I've become a transactor instead of a trend trader looking for longer moves. So basically, what I'm looking for is for psychology to overlap with technicals. So right here, Audi USD, we're sitting at a big fig, 73.04. So I bet a lot of breakout traders, because I used to be there, we're saying, okay, I'm gonna be the smartest guy in the world. I'm gonna sit on the beach and I'm gonna put a buy limit above 7,300, above the big figure. If it goes up to 73.10, you know, I'm in. Here to say we get a 73.6. A lot of people are afraid they're going to miss this move because they see the price action in here. But what they do not realize is how inefficient these legs are right here. Okay, now these legs here are coming in the Asian session when the books are first opening. So these are the true deal runs, and only by wrapping your mind around everything being the time of day, the price structure, and where the market currently stands and where it can go to pick up transactions. Because remember, banks aren't necessarily sitting here and trading. What they are doing is they're offering a bid and an offer looking to make the difference in the spread so they avoid risk at many levels. And yes, there are times where they can stack orders if they have an overall fundamental view, but that's not necessarily the case. So what we look for is for a parabolic spike into a predetermined level that we have interest in. And we can see that is exactly what happens here at 4 a.m. in the 3:55 in the morning. Okay, so we know London's kicked in for 55 minutes. So what we get here is a 20 pip spike up. We come right back. Now notice how this level here is inefficient. So is this. So we come back into it. We trade.
Why is it inefficient?
It is inefficient because there's no liquidity in the market at this point, and it doesn't take much.
So can you say that about Asia almost every day?
Yes, yes.
Okay, got it.
Unless Dale, the market is in a mode such as a Wednesday or a Thursday where there's so many orders in the market that they can't, there's standing orders in the market that it's not worth it for them to make a deal run and even put the risk on for that to occur. But we will get into further examples here that will show exactly what is happening.
How do you define a deal run?
The time of day, number one. So again here, Asian session, it's coming into Frankfurt, opening up its books. It's where my mouse is. It's 2:25 a.m. Eastern Standard Time is what I'm referencing here. Okay. So again, when we're sitting at this point here, I don't think that me, you, or anybody is interested in buying into this. You know, it makes no sense, but what makes sense to me is that the market wants to achieve a level where it's going to pick up transactions on the bid and offer so that it can pick up both sides and deal them to me and you and make that pip transaction, that 2 pip transaction, including, you know, on the institution side, we're usually paying just a commission to get into trades plus a small pip spread. So it's a commission-based game for the banks and the market makers. And yes, once in a while they will get in, they will place risk, but, you know, what people have to realize is we talk about it's a $4 trillion industry. So if it's a $4 trillion industry, imagine if you as a banker dealer can get a piece of that pie and get risk-free commissions off of those mass amounts of transactions that are coming in. So that is why they're called banker dealers, and that's why there are market makers, because market makers a lot of time are under the perception that 95% of the retail market is going to lose, so why wouldn't they take the opposite side of the trade? Because you're going to lose your money anyway, and they're also making the commission on the spread.
Okay, so, I have a question from the community. Someone who's a big fan of you, Alien Ovicho, who's a great trader in his own right, said, could you please ask Pete about his parabolic reversal? Give us an example if possible.
Yes, of course. Let me pull up.
You have fans. Alien would like an 8x10 autograph glossy picture of you to hang up over his screen.
Sounds like a plan. Let's see.
All right.
Yep. Give me just 1 second. All right. Before we show this guy, let me just remember that. Let me get this one because I believe, yes. All right. So this is my life story right here, and I know many have heard me mention the A trade, the support up, support down trade. And what I want everyone to understand before I share this is the psychology behind it. You cannot simply go in and look at 4 a.m. in the morning and look for the A trade to occur, such as this, or for support up, support down to occur. What you have to do is look at everything together in terms of starting from a volume base down here. Okay, so we can see at this point, I want to say this is about 14, so this is about New York session here. So we can see that the market just is in its consolidation. We have an overnight price run out of it. This is nothing that we're interested in trading in, but what we're interested in trading is the spike, the inefficient spike. Now notice how inefficient this is. So what this is here, in my opinion, at this point, this is a deal run. This is initiated here. This initial movement is initiated by some type of market dealer, some institution that just needs to get transactions so they can make commissions. So at times, because they know the human psychology of panic, where we chase price, and that is where we get a panic updraft that comes into price that we can see that is created by the retail side. Now, what we always look for in the market is a retest of a spike. So we have a dry run right here, okay, at the top, and we're sitting now here at 10 o'clock. We're 4 hours behind the GMT here, so this is 10:30 in the morning once again, New York. So I apologize. This was definitely here in the so 1 minute chart here, so stick with it and we'll get through it. So here we're at 10:48 where my mouse is. And over here, we're actually coming into 16, so we have 12:30. Okay, so we can see that London close is playing a big part in this trade. Okay, so what we have to understand is at London close, there are going to be institutions, traders that are exiting positions because we want to book profits, and that is where I wrap my head around transacting. I cannot stay in a market overnight anymore, no matter how good it looks, because I can't control it because I know how the books run. So nonetheless, we come in here, and this dry spike is created because for me to get out of a large buy, it's not necessarily, if you think about this for a second, if I want to get into a buy, I don't necessarily have to close it and sell it. It's considered a retail flip, and this is something that my brain thinks is true, and I can't confirm this, but I believe that if I'm an institution and I have created all the profit from here, if I can get the retail market to believe that this market is going higher, and that's the fear of missing the biggest move in the world, then I'm going to transfer my buy to you in terms of a buy to a buy without gaining a spread, but I'm able to absorb all the profits that I wouldn't be able to find because there's not liquidity of people looking for a sell on this position. So this is where we get into a London close A trade, because what we can see here is that inefficient market, so we spike up, and we can see a perfect triangle formed in here, okay? And what is happening is the A trade is going off of price reacts off of the risk. And again, flip side, if this is a movement down, it works exactly the same. So price at the shock and awe period, which I call it right here, price loves to use this point to overlap and create an A figure. Now, it's not only the A figure. What price is doing is it's saying, okay, we're going down. Now, a lot of people are seeing this last support, so a lot of the retail market is buying into it, okay? And here we have an efficient level. We have no more fear in the market of sellers, so we get the overwhelming sell. And then what we create is support up in the market, support down, because this is support of the parabolic spike. This is support of the parabolic spike to the downside, so hence the support coming up, support coming down. Then we bounce once again back into the A trade because this is where we're going to find liquidity. Again, just because here we have everyone selling, it doesn't mean that the market can instantly go down, because if there's not liquidity there, it's going to have to travel, because again, price's only function is to find liquidity for what the market is demanding, is going to have to travel down. Okay, so we get a spike up into liquidity, and what surprised me on this one is that we didn't see efficiency back into this level. Now, what I would have liked to see, but this becomes a part of understanding. If this was 10:30 in the morning US, we would have seen the market come back up into this level because there would have been more volume to the market. But in a less voluminous market, they do not have to create full efficiency. But you better believe that the market did come back and fill this efficiency. And it's all relative to the time frame. Okay, so you can't just jump on a 1-minute chart and start doing this. What you have to do is you have to start gripping your mind around looking at your hourly chart for inefficient levels, just as you look at it here on the 1 minute. So this is replicated, this figure here is replicated on a 1 hour chart all the time. And that's, again, because the market 80% of the time is range bound. So yes, we will get those 20% breakouts like this, but on every single level of compressions, even if you take it to the daily, please do the work and see how efficient this market is. And by efficient, what I mean is that when we have movements that are not sustainable, they will come back and correct price and create a volume base of interest. And you can see that happening here. And this is a great example of what I look for in every single transaction I take, being the A trade, the support up, support down trade. And then here what we can see is the best of all. This is just the cherry on top, as I call it. It's a gap slip, because this is the initial gap that we have coming out of this movement, which, again, remember, if this is the most efficient market in the world, it makes sense that if it gets taken on volume, which it gets taken here on volume, it is going to want to correct that at some point. It may be within an hour, it may be within a day, it may be within 2 days. But that is what you understand when you wrap around the whole sentiment of the market. And especially days as yesterday and days as Monday, where there's no fundamental drivers coming into the market. You see spikes, and again, the market is making deal runs so they can accumulate transactions and pick up the profit on the commissions. We'll take a look at live ones here in a little bit. So what we can see is, once we get into that volume base, price is just searching because it's a lost puppy. It has nowhere to go. There are no orders in that. What it was simply doing is coming back to this range that we have within here. And this is a range of 30 pips, and that's what the hero loves to do. So let's just continue on. Okay, so here's another 1 minute example. This is the pound dollar this time. So we can see here, okay, time of day, 5:08 Eastern Standard Time. Now, this run here could be created by simply one order coming into this market, because at this point right here, think how many transactions are coming in. Okay, so the market is going to want to go to the area that has less standing orders, or the area that in this dealing base here, in my anticipation coming out of a sell, okay, we go into consolidation. So I believe that the retail market on this opportunity here is accumulating sells. So if if the market just lets it sit for a little bit, think of all the liquidity here that an institution can just come in and sweep up in one clip. And that's where we see the mechanism of price coming in, and we see these spikes out of it. And just imagine right here at this point how many retail stops, because if you're shorting at this level here, your stop, I guaranteed, is going to be a couple pips up above here. So what we do is we pick up further liquidity in this market. These banks, these institutions know it because this happens every single day across all the pairs, because it is simply how the markets are dealt. Okay, so we come back into that, and this is where you will see over and over again that the market will spike out, come back to the previous area of deal flow. From there, this is what I consider the price chasers. And then this, coming back once again into the level of efficiency, we see that there is a deal run of those who are afraid that they're going to miss the biggest movement in the world. And then from that, we can see that we're coming into 6:20 in the morning. You know, I consider that to be the London lunch hour. And from there, what we can see that there is no more interest in driving up this pair, because institutions, banks, large traders know that what goes up must come down. And that is where we need to step in as the small guy, and we need to understand how the A trade plays into the support up, support down, look for the breaks of those, and trade it back to parabolic efficiency. And this area right here is going to be dealt with once again at a time where the retail market will be coming in. This is right here, 8 o'clock Eastern Standard Time, 8:05 to be exact. So you just imagine the injection of price that, the injection of bids that came into this. And then think about this for 1 second. If I bid this up and I put massive bids and that price has to attack to find the offers, which creates the movement, and then we pull back, and then we have the retail market coming bidding, and then we pull back, and then they bid it. Now, if I'm an institution and I'm London-based and it's 6:20 in the morning and I'm up 50, 60, whatever pips I am on my position on the institution side, what I'm going to do is start offering liquidity to the market on the offers. So
they drive it up to earn lunch money. And then after lunch, they have a little indigestion and they take it back down so they could pay the tip.
I really think that that's the way to put it to someone who hasn't taken, a year or whatnot to really understand it, and it's liquidity is if you can understand liquidity, you can understand why this happens. And again, for me to be able to get a 10 million position, there has to, on a buy, to bid it up, there has to be an offer of 10 million that I can get, or else price is going to jump out. So if I'm an institution and I'm trading that larger positions, my manager is not going to be too happy if I get filled here when I was looking to get filled here. So that is why they trade out of these volume bases. Does that kind of put a bigger picture on that?
You know what, Pete? You're a modern day 21st century tape reader. Our grandfathers used to sit there and look at the volume on initially a ticker tape, and then a screen, and just read what's happening on the buy and sell side. And you basically have taken it into the new century, being a tape reader in FX.
Well, so essentially, and I think what happened is that there's many things that evolved into me getting this type of structure in my trading. And this is my intraday trading model. It's totally discretionary upon myself, but what I'm saying is that I've tried the fundamental analysis, but as a trader, to simply trade fundamental analysis from the retail side and to follow the proper risk reward management that's going to keep you sane as a trader, you have to have a decent bank account. Now, I believe that 80-90% of retail traders that are coming in, they're sick of their 9-to-5 job. They probably have 1 to 5K that they can throw into an account. And these are things that the market knows. The market is very aware of this. I shouldn't say the market, the institutions, because the market is the banks that has price defending mechanisms, because again, they are interested in the bid and offer spread creating the transaction. Market makers are interested in driving to price so that they can hit these transactions. So you can just clearly see this happening on the Audi USD. Okay, and one tool that I do use is the Fibonacci, because we all know that the 161.8 is very respected. But I don't simply throw on the 1618 and say, oh, it's going there. You know, what I see here when I threw on this 1618 of my initial movement, and I'm always looking for initial movements that make sense. So this happened on Monday. We're coming into a big figure level. Okay, we're dealing at 4:30 in the morning. So in my mind, once again, we have trapped the market. And that's what market makers want to do. They want to trap the market because they want people to be on the buy side and they want people to come in on the sell side so they could just sell that as a dealer and make the commission. Okay, and here you can see the level of efficiency that is created in the market. So we have a parabolic spike, and then we come into this last inefficient level. So just notice how this candle right here, okay, just comes down and runs, 10 pips, and then we consolidate. Well, the market knows that that is an inefficient level, and it knows that if it wants to pick up liquidity, it has to go to the last area of efficiency, and that is where we come right into this place here called the 61.8 that the retail market looks at it, which is a beautiful thing to start understanding. And the reason why we use the fib zones, especially deeper fib zones with the 618, the 786, and the 886, is not because they work because they're magical numbers. They will work if you have a level of inefficiency at that level. Okay, so if I had a spike here that was straight up, and it was my last point of efficiency of the blunt candle was here at a 886, you better believe that that market is going to achieve that 886 before it continues. Okay, so the beauty.
Pete, we're kind of we're at the time zone right now where people that are listening to you right now, I'm sure, are interested in how they might be able to follow you, become involved with you. So why don't you go ahead?
Interest. I'll get into that because the only trade that I'm looking at currently is the pound dollar. And one thing that I've learned is not to force trades. So anyways, I just want to show this because this is very important to realize that this was Monday, okay? So we came back to core liquidity right here. Now take a look. This is core liquidity from that. This inefficient level was filled on this movement. Now, what is amazing is that we still, right here, just as this was inefficient, so is this area right here. This is inefficient. There's no dealing taking place in this. This is simply the market coming back to its home base of core liquidity. So what we can see that occurs is that the dealers know this and they bring it back up to this level. Okay, so now we're into Tuesday. Okay, so look what we have happen at this level. Let me just extend this across. Okay, so this is our last level of true demand in the market that is inefficient. Okay, so what do we have happen yesterday? And this is where I say that we have to understand that the market is range bound 80% of the time. So we have it come back into that exact area, and it repeats the whole process of an A trade, of an support up, support down trade. And this is something that we need to research, is the methodical breakdown of price once it is reversing. You can see that it doesn't just go straight down. We have a deal flow down, inefficiency, so the market comes and fills that, a deal flow down, okay, and this is possibly where you need to start understanding the time frames of the day. And we can see here this is 10 in the morning, so 10:30 a.m. Eastern Standard Time is a big time of reversals in terms of a movement up, getting the retail market thinking that this thing's going to the sky, and that is where the liquidity is going to come in, because if you're buying, and I'm an institution, I'm waiting to bid, or excuse me, for a sell, I can get my liquidity off of all of the retail's buys. So then we travel simply down. And yesterday, what I was posting on Twitter is essentially the initial movement out of this, and we can see that we nailed that 161.8. Now, once I saw this movement coming in later, my interest was struck, and what you can see is how precise these Fibonacci's are when you locate the actual initial movement, okay? And we can see that overnight, what the market did was fulfilled 161.8. So again, what you were looking for, in my perspective, the best place to start is literally on a 5-minute chart. Take a look at the deal runs that occur at 3 a.m. London, Eastern Standard Time. See where the market is by 4 o'clock. Have they created a trap in the market? And by traps in the market, take a note at this. And people realize that you will always see movements on the retest that will come within 2 to 6 pips. And why? Because think of, at this point here in the market, what is happening? Here we have sellers being stopped out because everyone is putting their stops below, and we also have buy stops coming in above price because continuation. So at this point, the liquidity is dried, and that's why we see a sharp reversal. But what happens there is that market makers are pocketing all of the stop outs. You are handing them your money. And that is by having the psychology of an independent thinker, you can understand what you're actually looking at. So in my opinion, the best thing to do is just grind out price. Grind out price and realize every time a large movement comes that it is going to come back to some degree of efficiency. And you can even see it right here. Market runs up and it comes back to its last degree of efficiency where there was dealing that occurred. This is somewhat efficient in its terms. Okay, so let's just take a look at the pound here.
Okay. Go ahead.
So all the analysis that I do at this time is going to be on 5-minute charts, okay? And that doesn't mean that I'm neglecting what's going on larger time frames. So what we can see here, let's just take this to a 4-hour and kind of show the average type of technical analysis, right? Supply and demand lines, in my opinion, the Fibonacci's and whatnot, support and resistance. So what we can see here on this 4-hour is a very evident point of supply in the market. You know, we're coming back here from this August price level, perfect respect down in here. There's a lot going on, so we can't really see it. So let's just note and start getting into this. Okay. So let me just see if we can get a better picture on the 30. I apologize, but when you get to the point where you're stalking a currency pair, and we talked about this in the past, you will start to see that you don't even need any of this on there. So nonetheless, what is interesting is that yesterday we took this short down, and the reason that we took this short down is that we had those setups that we're looking for. I'll get back to the larger compression, but we can see that here we had a 230 deal spike, okay, and that, again, there was nothing happened in the market yesterday at 2:30 in the morning Eastern Standard Time to see the pound run 37 pips. But take a look what's right here. The 155.00 handle. So liquidity pools are going to be standing at this because liquidity pools are created by institutions that need to get in for the transactional opportunity. And you better believe that liquidity pools control this market in terms of larger picture. So when you are trading the market and you're looking for reversals, and they're not necessarily reversals because this was, again, on the 4-hour time frame, we were looking for a continuation to the downside, correct? So what we have to understand is that if the market just turned on that supply line, the whole world would be paved with gold because everyone would be able to get in and trade that. It's not that simple. So you have to take it upon yourself to create an intimate understanding of what they are trying to do so that they can take our money and pay themselves. Because if there is not a loser, there's not going to be a winner. So we have a deal spike on a 5-minute chart. So here within 20 minutes, they get up 35 pips. And then we create parabolic movement right here. And this only takes a matter of an hour and 10 minutes. So here at 4 a.m. London, we're sitting, and what is now happening? Now everyone is saying that, hey, oh no, I missed this movement. I got to get in. It's London. I see what they did. They did a deal run, and they're coming. That's stop run as people want to see it. But again, they don't realize that this is standing liquidity here in the market. We get the movement down. This movement is highly inefficient. And when we see reversals taking place, but please don't take it as a reversal in terms of sentiment. Take it in terms as a reversal in price action. We know that price is going to methodically break down, or else it's not worth our time to get interested in that. And you know what? You may see 2 out of 10. You may see 3, 4 out of 10 that just simply break down and you don't have the opportunity. But that's where you have to be precise in your entries. So we get a retest of the market coming back into core efficiency, and then we start seeing nice dealing. So we go down, we come up. We go down, we come up. We go down, we leave an area of inefficiency. We are dealing within here, creating a mine sore for the entire world, spike into that inefficient level, and then we see finally At 10:15, hence what I said earlier, 10:15, or excuse me, 10:30 is a big dealing time. We see the market come down, and this right here was my entry from yesterday. And this, in my terms, is what I call the flip of flows. Okay, so you can see that I had a shift of flows here, but I wanted to see what 10:30 was going to bring into the market. So I could see that right at this time, 10:15, 10:20, 10:30, my entry candle, I get a spike up to it, and from there I'm short because my risk is very limited, and I'm not going to say that I put it up above. My risk is going to be right here, because if that market goes up above, I want out. I want out for 10 points. I want out for 15, because I know to the downside that I have at least 30 pips of potential profit in my bank. Okay? So currently what I'm looking at here on the pound is what happened overnight. Okay? So we saw the market achieve its range of 94, 95 pips overnight, okay, into a deal run, whatever you want to call it. And take a look at that time. It's 2:30 in the morning Eastern Standard Time. If I can give you one piece of advice, it is understand timestamps. Once you understand timestamps, understand liquidity pools, and once you understand liquidity pools, understand how this is the most efficient market in the world, and that gaps that are created will be filled, and then overlap that with an average daily range, because don't just pick a number and say this is my average daily range, right? There are tools out there that allow you to backtest and say what my 10-week average daily range is. Mataf.net is a great site that I use all the time just to quickly see the difference between a 10-week average daily range and a 4-week average daily range, and even a 2-week average daily range. And realize that
tool, Pete, what's that tool again?
It is it's the volatility calculator on mataf.net. It's a free tool. I've been using that site for years. I think it may be called Forex Ticket now, but when I go mataf.net, it just clicks it right in for me.
All right, thank you.
Yep.
Great presentation, Pete.
Yeah.
Thank you so much for joining us today.
No problem. No problem.
The theme is be a transactor.
Yes, yes. And just one more second here, because I want to finish up what I was looking for today, and you'll be able to see what happened. So this area of inefficiency, okay, we can see that the market came overnight into it. But what happened at this level? My average daily range was fulfilled. My 161.8 and 161.8 expansions work because when banks and institutions initiate and bank their money here on the initial movement, because they are the only ones that can create the initial movement, what they need to know is a target point that they can take for it, okay? So again, we inefficient market, and this isn't a parabolic spike, and this is where you know that a reversal is coming in here today, and that's where you know you can come back into this market and take a transaction for some pips, is we get a deal run off, but we didn't just spike back into it. There is dealing coming in. Look how efficient this market dealt to as opposed to this market right here. Okay, so we get market right here. We're sitting at 5 a.m. We get a spike, consolidation. Okay, so the trade that I was looking for today was I wanted at the 10:30 hour, I wanted the market to come back here to the 154.30 level. And if we did, I was going to chase inefficiencies that were left in this market right here. And note, that's why I said yesterday I exited my trade early, because of the inefficiency. And simply, you have to understand that it may not be to your basic eye a big inefficiency right there, but to the trained eye, you understand that this is where the market must go in terms of liquidity. Okay, because there will be standing liquidity once again at this area. Now, this is what occurred today. We can see that market came right, full its efficiency, and what we're doing right now is we are driving right up into that. And this is where you can start to develop a mentality to see the flows. And these flows come in forms of triangles that you can see right here. Okay, so triangle there. Okay, and then overall, what we're creating is, is a efficient level of dealing throughout the market. And it's not a trend line, it's efficiency. You see that? How the market always fills itself. So this is if I can give one piece of advice, it's this. If you're interested in buying at this point, wait for a deal spike to occur. If it goes to the moon, who cares? Wait for it to consolidate. Wait for it to come back at a perfect time of day. Perfect time of day being anytime after the 8:30 hour if you're trading New York, right? 8:30, be aware, that's where you have to look for stop hunts to occur. And it's possible because there's not a lot of liquidity in that market at that time. Okay, so at this point here, you would say I am a buyer because we have fulfillment of yesterday's average daily range. We created efficiency, and now we have left an inefficient level up here. Well, don't take this lightly, my friend, because this to this is 40 pips. Now, last piece of pie, if you can make 40 pips daily in this market and focus on building your account size, stop chasing pips, start transacting, perfect 30 pips. If it goes 100 pips, who cares? Take your 30 pips and pat yourself on the back. Take what we call the center of the melon and leave the top and bottom for the rest who haven't yet figured it out. It's a painful occupation, but once you get the intelligence behind it and understand the anatomy of the market, you will see how rewarding it can be. And, that's all I can say.
All right, Pete. Yeah, you're very, as everyone could tell, you're very passionate about teaching people about this method. So I encourage people to follow Pete at Forex Shrink. Any other place that people could get in touch with you and
so I have my website, forexshrink.com. We have been doing 3-month, 10 people presentations, university, what we like to call them. And the reason why we spend 3 months with people is because I can't give you in 2 days or 3 days a system that is going to work, right? If you're going to make the sacrifice of time, I will make the sacrifice of a guarantee on your success. And that is, if you show up every day, I will show up every day, and I will show you what to look for. And that is key. Please do not spend your money, people, your hard-earned money, on 2 to 3 day packages. They have nothing to offer. If it was that easy, this world would be a totally different place. Money would not even exist because it would be out of circulation. Okay, so repetition, create an understanding, find your understanding in the largest market in the world. You don't have to catch every move. Catch 30 pips. Try to accumulate 500 pips a month. Try to double your positions every 2 months, every time you capture those 500, and you will see in the matter of 2 years what you can do. It is amazing. If anything, right now at the end of this presentation, I suggest that you take and see with $5,000 if I risk every day 1% of my account, and I am looking for every month to capture 500 pips. And every time I capture 500 pips, I'm going to add to my position size. See what you can do if you capture 500 pips 12 times, which could be a fiscal year, or if you're ambitious, you could do it in 4 months. It all depends. So I want to thank you guys for your time once again. I'm sorry if I was kind of over the place, but it was last minute. This came up yesterday, so I do apologize.
Thanks for your time, Pete.
No problem.
Appreciate it, and good hunting the rest of the fall trading season. Keep in touch, and I appreciate all your retweets on Twitter. Glad I know you, Pete.
Pleasure's all mine, my friend.
Okay, buddy. Thank you, Pete.
Take care.
Adios.